The program examines volatility, correlation, and dispersion products and strategies used within alternative investment and derivatives markets. These strategies allow investors to gain exposure to market volatility and correlation independently from directional market movements. Volatility and correlation are increasingly treated as tradable risk factors because they significantly influence portfolio performance, derivative pricing, and market behavior during periods of stress. Investors use specialized derivatives and trading structures to hedge risks, generate returns, or exploit pricing inefficiencies related to changes in volatility and asset relationships. The program emphasizes that these strategies require advanced risk management because leverage, nonlinear payoffs, and changing market dynamics can produce substantial gains or losses in rapidly evolving financial environments. Options are widely used to manage volatility exposure and capture volatility risk premiums. Investors often purchase options to hedge against adverse market movements because option values generally increase during periods of heightened uncertainty and volatility. At the same time, selling options can generate premium income when realized volatility remains below implied volatility embedded in option prices. The program explains that volatility risk premiums exist because many investors are willing to pay for downside protection, creating opportunities for option sellers to earn excess returns under stable market conditions. However, short volatility strategies can experience severe losses during sudden market disruptions. Effective volatility management therefore requires balancing premium collection opportunities against tail risks and maintaining disciplined hedging and risk control practices. Volatility trading frequently involves delta-neutral portfolios designed to isolate volatility exposure from directional market risk. Delta measures an option's sensitivity to changes in the underlying asset price, and delta-neutral strategies attempt to offset these directional exposures through hedging transactions. By maintaining a delta-neutral position, traders focus primarily on changes in implied or realized volatility rather than market direction. The program highlights that delta-neutral portfolios are dynamic because hedges must be adjusted continuously as market prices move and option sensitivities change. Gamma and theta also become important considerations because option convexity and time decay influence portfolio profitability. Successful delta-neutral volatility trading therefore requires active management, quantitative modeling, and continuous monitoring of derivative exposures. Option-based volatility strategies encompass a broad range of investment approaches designed to profit from volatility expectations, market dislocations, or relative value opportunities. Common strategies include straddles, strangles, calendar spreads, butterfly spreads, and volatility arbitrage structures. These strategies may benefit from rising volatility, falling volatility, or changes in the shape of implied volatility surfaces. The program also discusses variance-based and volatility-based products, including variance swaps and volatility futures, which provide direct exposure to market volatility without requiring traditional directional market positions. Variance swaps allow investors to trade realized volatility against implied volatility expectations, while volatility futures provide access to future implied volatility levels. These instruments expand the range of tools available for managing and monetizing volatility exposures. Correlation swaps and dispersion trades represent advanced strategies designed to isolate and trade the relationships among asset returns. Correlation measures the degree to which assets move together, and correlation trading allows investors to speculate on or hedge changes in these relationships. A correlation swap enables investors to exchange realized correlation against a predetermined correlation level. Dispersion trades typically involve taking offsetting positions in index options and options on individual index constituents. These trades seek to profit from differences between implied index volatility and the combined volatility of individual components. The program emphasizes that dispersion strategies are highly sensitive to changes in market correlations because index volatility depends heavily on how closely constituent assets move together during different market environments. Volatility hedge funds and specialized trading strategies play an increasingly important role within alternative investments because of growing investor demand for diversification and downside protection. These funds often employ relative value trading, volatility arbitrage, correlation trading, and derivative-based hedging techniques to exploit market inefficiencies and changing volatility conditions. Some strategies seek to generate steady income through volatility risk premiums, while others focus on crisis alpha and tail risk protection during market stress. The program highlights that volatility-focused hedge funds require sophisticated infrastructure, quantitative expertise, and strong risk management systems because leverage and derivative exposures can amplify both returns and losses. As financial markets become increasingly interconnected and complex, volatility and correlation trading continue to evolve as significant components of institutional portfolio management and alternative investment strategies.